The concept of the fund is simply to carry out active fundamental value investing in emerging markets. At the most basic level, what this means is that we try to invest in companies where we think the current share price is heavily discounted to the long-term value of the company. We do this through a rigorous process of screening, detailed fundamental analysis, and disciplined risk management. We also integrate environmental, social and governance analysis into our process, and in this fund we exclude certain companies on the basis of an ethical screening. So for example, involvement in certain industry sectors or in confirmed violations of international norms in the areas of the environment, human rights, social issues or governance issues. What we think this gives you is a fund which has good diversified exposure in terms of countries and sectors, obviously interesting individual stock picks, but also we think overall three key drivers for performance. The first would be the selection of individual stocks, the second would be exposure to the value effect over the long term, and to some extent exposure to small and mid-cap stocks, which we think can help drive long-term returns. The fund has performed fairly well since launch in the middle of 2012, and the main reason for that over the period since launch has been the selection of individual stocks above all. We do aim in the long run to have performance driven by value as well, but in reality the period since 2012 to certainly 2015 has been a period where value overall didn't perform particularly well. So it's encouraging to us that despite one of the key drivers for the fund not really firing during that period, we still generated decent returns. In the shorter term, so in 2016, the fund continued to benefit from selection returns, so individual stock picks doing well. Some examples would be Yes Bank, a bank in India, Mando, which is a Korean auto parts company, and elsewhere Xingde, which is a Chinese maker of cables for reinforcing car tires. But also in 2016 we saw a phenomenon which was encouraging, which is that the value effect overall started to kick in and drive returns for the funds. That happened in developed markets but also emerging markets, and this combination of both the value factor driving us and our selection returns led us to over 20% returns in euro terms during the year, well ahead of the benchmark MSCI emerging markets. And it's encouraging to see that this has been rewarded with an award for the best emerging market fund in Sweden during 2016. So it's been a positive period. We think it's a very interesting time for value in emerging markets. There is a lot of evidence to show that value works as a long-term performance driver in emerging and developed markets, but it's also true that there always have been periods of short-term underperformance for value, and the reality is that the last few years have been one such period. One simple factor to bear in mind is that when you have an asset class which has structural long-term outperformance going through a period of underperformance, the longer that lasts and the deeper it goes, arguably the more potential there may be for a reversion. So from a diversification perspective, it's a good idea to consider taking that asset class, value stocks, into your portfolios. Another factor which we think is interesting to look at is the role of interest rates. Now, the last few years have been a period where global rates, but especially the US and Europe and Japan, have been at ultra-low levels, and that's had a significant impact on global asset allocation. You've had certain parts of the equity market benefiting from a status almost as alternative for bonds. So for example, the defensive, maybe slightly more expensive parts of the market, which are perceived as more stable or maybe higher growth, they've benefited from massive fund inflows, while other parts of the market, such as value stocks, have suffered. We think that that's to some extent understandable from an asset allocation perspective, but of course there has long been a risk that as interest rates or interest rate expectations start to rise, that flow would reverse, and indeed in 2016 we've started to see that. US long-term interest rates have been moving upwards, and as that's happened we've seen a global rotation out of growth stocks to some extent and into value stocks, and certainly we saw that in emerging markets as well. Another factor in emerging markets, and this is maybe slightly counterintuitive, is that when you have periods of accelerating or improving growth in emerging markets, it's not actually growth stocks that usually benefit the most, it's usually value stocks. And we think one reason for this is simply that as you have more growth in the overall market, there's less reason for investors to focus on a few higher growth stocks and pay more for those. Instead, look down to some of the cheaper stocks, which are also starting to see more growth and accelerate, and that can give you quite good returns. And I mention that because we think the next few years in emerging markets could be a period where you start to see GDP growth and earnings growth re-accelerate relative to developed markets. The last few years we've seen earnings growth in emerging markets weaken relative to developed markets. It's also been a period where emerging market returns were somewhat weak relative to developed markets. That started to change in 2016, and we think that pattern could continue over the next few years.